The last housing market crash in 2008 was disastrous to many people across the country. Countless families could no longer afford their mortgages, homes were in foreclosure, and workers were losing their jobs left and right. Could this be happening again? Is now a good time to buy a house, or should you wait for a possible market collapse? This could be your last chance to buy a house if prices continue climbing, but if home prices see a steep decline, it could be an amazing opportunity. What does a housing market crash look like, and how can you prepare for this event? This video will not only discuss how often and how severe a housing crash could be, you'll also learn how to buy a home that will be an incredible investment. Watch the whole video because making an educated decision on your largest purchase could set you up for a lifetime of financial prosperity. My name is Chris, and I help teach people about money, personal finance, and investing. If you're interested in improving your financial future, make sure to subscribe to the channel and hit the like button if this video is helpful. A housing market crash is a sharp decline in real estate values caused by various influences. Seeing a huge value reduction of what is the largest asset for many families is a lot to stomach, and a decline in home prices can severely impact net worth. It can cause a sweeping reduction in overall spending, creating a snowball effect of dropping prices in different segments of the economy. Similar to a stock market crash, there are various events that could trigger a steep decline in housing prices. Rising interest rates make homes less affordable to buy because they play a large part in a monthly mortgage payment. Just a 1% or 2% increase can make a large difference in the monthly payment. Over the past couple of years, we've seen incredibly low interest rates causing an increase in demand for property, but those rates have now risen, making it more difficult for some people to qualify and afford a mortgage. Problems with the housing market could also stem from higher unemployment, subpar lending practices giving loans to buyers who aren't qualified, skyrocketing inflation making everyday expenses nearly unaffordable, or a drop in consumer confidence. Many fear another major housing crash like what was seen during the Great Recession. It's understandable considering prices have been on the rise since then. Seemingly everyone was upside down in their homes, owing more than what they are worth. This negative equity, combined with job losses and other factors, resulted in an abundance of short sales and foreclosures. These properties flooded the market at once, adding to the steep drop in prices. That could happen again, but historically speaking, steep declines like what we're seeing during that period are very rare. Actually, that's the only time they've dropped considerably in recent history, with the crash presenting historic declines of about 20%. The Great Recession was unique in that it was caused by the housing market, not the other way around. By taking a look at this graph of the average home price, you can see that even though prices fluctuate from year to year, they don't typically decline significantly. From when home prices peaked back in 2007, it took over 6 years or until late 2013 for prices to regain their all-time highs. That means that if you had purchased right at the very top of the market, you would have been in the red for over 6 years. Other than this extreme period, you can see that housing prices, for the most part, rise steadily year after year. When prices do drop, they only fluctuate by a few percentage points here and there, and the drops do not last for prolonged periods. Potential homebuyers who have yet to buy their first place are ecstatic at the thought of a drop in home prices. It sure would be nice to buy a house at the levels seen a few years ago, or even better, 10 or 12 years ago. As interest rates rise, you could assume that prices would cool off as buying a home becomes less affordable, but are reduced prices actually going to be of benefit? Take a look at two different scenarios and the monthly costs you could expect. Putting 5% down on a $500,000 house at 3% interest would mean a monthly payment of principal, interest, average taxes, and insurance of $2,825. Now let's say you get lucky and home prices drop 20%, on par with the largest drop in history. In other words, in order to realize a 20% discount, you'd have to compare the very top to the very bottom, so perfect timing would be necessary. Prices are now more affordable, so you can get the same exact house that was previously worth $500,000 for just $400,000, only now your interest rate might be 8%. Your monthly mortgage payment is now $3,467. This is a great opportunity for a wealthy cash buyer, but is it really an amazing chance for the first-time homebuyer? The short answer is, it depends on how long you plan on keeping that higher interest loan. Famous hedge fund manager Peter Lynch has said, "Far more money has been lost by investors in preparing for corrections or anticipating corrections than has been lost in the corrections themselves." Home prices might come down, but that doesn't mean you have an advantage over someone who bought a year or two ago. Even if prices drop 20% or more, homeowners who purchased a few years ago will still be ahead. The average home price at the bottom in 2020 was 31% less than it is today. By looking at the graph of home prices, you can see that they almost always rise, so is expecting a never-before-seen drop realistic? Prices could double again as you wait for a 20% discount in home prices that may or may not come. Buying a home is a long-term investment, so you should look at future pricing as such. If you buy now, ask yourself if you're going to be happy with that choice in 2, 5, or 10 years, not necessarily 6 months. Housing prices could certainly drop, and anyone thinking about buying a home should understand this. Current factors like large declines in the stock market, rising interest rates, and soaring inflation could point to a reduction in home prices. The fact is, no one knows for sure where things are headed, so it doesn't make a whole lot of sense to obsess over it, but be prepared either way. Similar to timing the stock market, this strategy usually doesn't work out unless you're a professional investor. Instead, you should focus on factors you can control that will drastically increase your chances of your home being an amazing investment. When looking for a home, stick to desirable, growing areas where people are moving into, not away from. Consider proximity to stores, schools, highways, airports, and attractions, as well as areas that are being improved and are expanding outwards. Buy the worst house in the best neighborhood. Not to be taken literally, but the point is that appreciation is usually higher for the less expensive homes in nice areas because there is more upward potential. Everyone wants to be in a nice neighborhood, even if they can't afford the biggest house in the block. Don't buy a house for its new finishes. Buy a house for its location, yard, functional design, build quality, and other factors. These are everlasting characteristics when compared to trendy flooring and light fixtures that are going to be outdated in a few years. Stick to the lower end of your budget and make sure you have plenty of cash left over for maintenance, repairs, and upkeep. It will not end well if you max out your monthly budget only to find out the costs of owning are much higher than you anticipated. Buy a home with income potential, whether it be a mother-in-law suite or an accessory dwelling unit. Consider its rental potential if you ever decide to rent out the entire home when you move into a new one. Rental income received from renting out part of your home can be used to offset the mortgage if you want it or need it in the future. Select not only a home you like, but one that potential buyers will appreciate when and if you decide to sell. Most first-time buyers only keep their home for 2 to 5 years, so attempting to stretch your budget in hopes of finding your forever home is unreasonable. Look at the purchase from a value standpoint and avoid becoming overly emotional. Many buyers choose a home based on emotions, and understandably so. Home buying is an exciting process, but don't make a long-term decision based on short-term emotions. There's always going to be an obstacle to buying a home, whether it be rising interest rates, rising prices, or something else. Just like investing in the stock market, starting a business, switching jobs, or anything else, there's never a perfect time to begin. Understand how the housing market moves from year to year and have realistic expectations about where it could be headed. Having your ducks in a row by having plenty of money to make a purchase and looking at the purchase from an investment point of view will maximize your chances of making a great choice.